Welcome back to the channel. Today, we're doing a deep strategic and tactical dive into the US digital currency market for the first half of March 2026. This isn't just about short-term price charts. We're at a structurally significant inflection point, a unique convergence of monetary policy, institutional capital, new regulations, and post-halving supply dynamics is creating a high volatility, high opportunity environment. Think of this not as just another trading window, but as a crucial microcycle within the broader expansion that started after the 2024 Bitcoin halving. To understand where the market is headed, in the first 2 weeks of March, we need to break down 5 dominant forces: macro, liquidity, the regulatory landscape, institutional, ETF flows, the technical market structure, and what the on-chain data is telling us. Let's get into it. First and foremost, macro liquidity is the core driver of all risk assets, and crypto is no exception. Bitcoin and major altcoins act as beta assets. In plain English, when the Federal Reserve is tightening its belt, crypto feels the pressure. When they are easing and injecting liquidity into the system, crypto amplifies those gains. So, in early March 2026, all eyes will be on the Fed. Traders are watching for key inflation data like the CPI prints, any forward guidance from the Federal Open Market Committee, and how Treasury yields and the US dollar are behaving. If inflation data comes in softer than expected, we could see a rapid acceleration of risk-on sentiment. In that scenario, Bitcoin might reclaim key resistance levels, and we could see short, explosive bursts of outperformance from derivatives. Funding rates would likely shoot into positive territory as optimism grows. On the other hand, if inflation reaccelerates, the opposite happens. Treasury yields would rise, the dollar would strengthen, and crypto would likely face short-term downward pressure. The first half of March is going to be incredibly sensitive to this liquidity dynamic. Expect markets to try and front-run these big macro announcements, which means volatility will probably spike even before we get the official news. Now, let's talk about the market's anchor, Bitcoin. It remains the structural benchmark for the entire digital asset space. Entering March 2026, we're likely to see Bitcoin trading within a defined consolidation band after a period of volatility. There are a few key price levels everyone will be watching. The major support zone is sitting between $62,000 and $64,000. The mid-range pivot point is right around $67,000, and the major resistance band is up between $70,000 and $72,000. From here, 2 primary scenarios can unfold. First, the bullish scenario, which is a probability-driven breakout. If Bitcoin can sustain its price above that $67,000 mid-range pivot, momentum traders will likely jump in, trying to catch the breakouts. This could trigger a cascade of short liquidations, pushing the price up even faster. And all of this would be amplified by institutional spot ETF inflows, compounding the price appreciation. If this plays out, the first half of March could see a rapid move toward that $72,000 resistance. The second possibility is the bearish scenario, or what we call a liquidity sweep. If Bitcoin breaks below that major support zone, it could trigger intense liquidations in the derivatives market, and funding rates would flip negative. This would cause amplified drawdowns across the altcoin market. However, a move like this would likely be short-term in nature, unless it's accompanied by a major negative macroeconomic shock. Next up is Ethereum and the broader smart contract ecosystem. Ethereum serves as the structural backbone for decentralized finance, or DeFi, and the growing world of tokenized assets. The key drivers for ETH in early March will be the allocation flows into its own ETF products, the continued growth and adoption of Layer 2 scaling solutions, and the stability of the total value locked or TVL within its ecosystem. The relationship between Ethereum and Bitcoin is a critical market indicator. If the ETH-BTC ratio starts showing strength, it's a sign that risk appetite is expanding. This typically leads to intensified altcoin sector rotation, with DeFi governance tokens potentially outperforming. On the flip side, if Ethereum underperforms Bitcoin, it signals that capital is staying defensive, concentrating in Bitcoin and a few other high-liquidity large caps. Ethereum's performance relative to Bitcoin in early March will be a huge tell. It will signal whether we're re-entering a broad expansion phase or remaining in a Bitcoin-dominant market. This brings us to altcoin rotation cycles. Historically, altcoins move in predictable phases. It starts with a Bitcoin rally, then Ethereum confirms the trend. After that, capital rotates into large-cap altcoins, followed by a more speculative surge into mid-cap tokens. Early March 2026 could represent the tail end of Phase 2, the Ethereum confirmation, or the very beginning of Phase 3, the large-cap rotation. Projects with strong institutional narratives, like those related to AI, infrastructure, or scaling solutions, are likely to outperform. However, if the macro environment remains uncertain, traders often retreat to the safety of Bitcoin and high-liquidity large caps. We should expect volatility clustering in mid-cap tokens, with the potential for sharp 15 to 30% moves in very short time frames. One of the biggest structural shifts in the market since 2024 has been the normalization of spot Bitcoin ETH. These institutional mechanics are against ETF flows, create continuous bid pressure on Bitcoin, ensure consistent institutional allocation, and reduce the risk of those reflexive, cascading downside moves we saw in previous cycles. The logic is simple. If early March sees positive net inflows into these ETFs, it will help stabilize the price and support breakout attempts. If we see negative flows, we can expect short-term pullbacks. We also need to consider quarterly portfolio as we start the second quarter. Wealth managers and institutional allocators might be adjusting their risk exposure, which could impact liquidity dynamics in early March. Beyond the price charts, we have on-chain metrics to silence signals that often precede major market moves. Key metrics to monitor include exchange inflows, which can indicate selling pressure. We'll also look at long-term holder supply stability, whale wallet accumulation, and miner selling behavior. If exchange inflows remain low and long-term holders aren't selling, the downside risk is compressed and the probability of a breakout increases. Conversely, if we start to see large whale wallets distributing their holdings, volatility is likely to expand, and the market structure could weaken in the short term. The derivatives market is another crucial piece of the puzzle. It's the volatility amplifier. The perpetual futures market significantly influences short-term price action. We need to watch for a few things. Open interest, expanding without a corresponding price movement, which can set up a potential squeeze. We also need to monitor funding rate extremes. If funding becomes excessively positive, it increases the risk of a long squeeze where over-leveraged bulls are forced to sell. If funding becomes deeply negative, it sets the stage for a potential short squeeze rally, where bears are forced to buy back their positions. Early March often sees a period of volatility compression followed by these kinds of breakout conditions. Sentiment is another factor that can't be ignored. Crypto sentiment oscillates rapidly between extreme euphoria and extreme fear. We can track this using tools like the Fear and Greed Index, spikes in social media volume, Google search trends, and the growth of stablecoin supply. A classic contrarian setup is when fear dominates the market. but the price stabilizes is often a strong bullish signal. On the other hand, if greed is dominating as the price approaches a major resistance level, the probability of a pullback increases significantly. Finally, there are some unique structural catalysts in play for March 2026 that supports a cautiously bullish bias. The post-halving supply compression is still in effect, reducing the new supply of Bitcoin. We have increased institutional acceptance, broader fintech integration, and the continued expansion of tokenizing real-world assets. However, despite these strong fundamentals, short-term market behavior will remain highly reactionary to macro headlines. So, what can we expect in the first half of March based on all these factors? Combined macro, technical, institutional, and sentiment. The most likely scenario is some initial volatility followed by range-bound consolidation. If the macroeconomic data cooperates, we could see a breakout attempt toward the upper resistance levels we discussed. An alternative scenario involves a liquidity sweep below the key support level, followed by a rapid recovery fueled by institutional ETF buying. This would lead to a significant volatility spike around the middle of the month. The least likely scenario, a low probability event, would be a major macro shock that triggers sustained downside across the market. So, what's the strategic takeaway? The first half of March 2026 is likely to be characterized by elevated volatility, price reactions that are highly sensitive to liquidity conditions, and an underlying bid from institutional players that will likely cushion any major weakness. This creates an environment ripe with tactical trading opportunities, but also one that demands a controlled approach to risk. This is not an environment for emotional, reactive trading. It's a time for risk-managed positioning, level-based execution, and a primary focus on capital preservation. It's a time for strategic accumulation during moments of weakness. The market is transitioning from its speculative adolescence into a phase of institutional maturity. The short-term noise will remain, but the structural foundations are significantly stronger than they've ever been. Thanks for watching. If you found this analysis helpful, be sure to hit that like button and subscribe for more deep dives into the crypto market. See you next time.